If you've ever felt like banks just don't understand how entrepreneurs make money, you're definitely not alone. Maybe you've been told you don't qualify or that you need to pay yourself way more in order to. The mortgage system wasn't built for people like us. That doesn't mean you can't get the financing you deserve. Welcome to my training on mortgages for entrepreneurs, where I'll break down exactly how self employed professionals, business owners, and freelancers can qualify for a mortgage without the usual stress and frustration. By the end of this session, you'll have a clear roadmap to understand exactly what lenders are looking for when you're self employed, learn key strategies to increase your mortgage approval odds without overpaying on your taxes, find out which mortgage path fits your situation so you can take action today. I'm Marshall, a mortgage broker here in Toronto with 12 years of experience, and I've helped over 500 families, borrowers secure more than $250 million in financing. Plus, I've been an entrepreneur myself for the past 20 years, so I know exactly what it's like to juggle business and personal finances. That's why I created this training to make sure you have the tools you need to qualify for the right mortgage without compromising your business's success. So grab a coffee, eliminate distractions, and let's dive in. If you stick with me by the end of this video, you'll know exactly what your next step is towards getting approved for a mortgage, whether you're ready now or need a game plan to get there. Let's go. Mortgages for entrepreneurs. Owning a business shouldn't make getting a mortgage hard. And here's how we're going to fix that. So, owning a business is hard from operations, marketing, and accounting. You wear a lot of hats. My goal today is to help you understand how you qualify for a mortgage and what it means as an entrepreneur. A little bit about me before we start. I graduated from Dalhousie University in 2006 with a BCom major in finance, and I've been self-employed ever since. I'm passionate about my family, achieving financial independence, and my mental and physical health. I love what I do, particularly working with other entrepreneurs and helping them achieve their housing goals, especially while keeping unnecessary money out of the CRA's pocket. I live with my wife, also a business owner, and our kids in Trinity Bellwoods in Toronto. And I was born and raised in Toronto's East End in a little neighborhood called Cabbagetown. How you qualify for a mortgage. Lenders are going to look at three pieces of information on every application: your credit score, your down payment, and your income and debt. Let's start off with your credit score. It impacts options and rates. You need a minimum credit score of 680 to get access to minimum down payments, interest rates, these kind of things. Above 620, down payment requirements go up. Below 620, now you're getting into some more alternative lending solutions. Credit score is going to equal how well you've managed your debt. So here's how the credit score is determined. 35% of your score is based on your payment history over the last 7 years. 30% is going to be based on credit used versus credit available. You got a $10,000 credit card and you got a balance of, say, $5,000 on there, you're using 50% of your available credit. That's going to factor into your score. 15% is going into credit history, how long you've had the accounts that are reporting on your credit report. 10% is based on history of bankruptcy, consumer proposal, or collections. Keep those things off your credit. 10% is down to inquiries. So anytime someone's checking your score, whether it's applying for a credit card, a car loan, a mortgage, that is going to be logged on your credit report and it's going to impact your score slightly. Know your score and manage it carefully. It's so important to pay things on time and manage your balances. Make sure it's a priority. Down payment. Less than 20% is considered high risk. This means that lenders have to get mortgage insurance on your mortgage. You now have to meet the insurer's guidelines on top of the lender's guidelines. It gets a lot tougher. If you've got more than 20% down, then it's considered a low risk mortgage, which means now there's no insurance required. You're only meeting the lender's policies. They can get a bit more creative and you don't have that additional cost of mortgage insurance. And then we've got minimum thresholds that you have to meet. So in Canada, 5% of the first 500,000 is required. Once you get above 500,000, now you have to have 5% of the first 500,000 plus an additional 10%, and that goes all the way up to 1.5 million. Kind of example on that, if you were looking at a home of 600,000, 5% of the first 500,000 is $25,000. And you got an additional 100,000 to get up to 600,000 at 10%. That's another $10,000. You must have $35,000 down. Anything over 1.5 million must have 20% down. Third, and probably the most important factor they're looking at is income and debt. First, what income will the lender consider? They look at all sources of incomes from all the applicants on the mortgage. That includes employment income, self-employment income, child tax benefits, child and spousal support income, pension, investment income. What do you got and what can we show to the lender as support for that income? And then they're going to look at what existing debts you currently have. What's going out? Car loans, car leases, student loans, personal loans, credit card or line of credit balances that don't get cleared on a monthly basis, spousal or child support payments. And that's going to get us to the all important number of how much can you take on for a home. There are guidelines for percentages of debt to income. Your debts will either play a factor or not, but income is going to be the biggest factor in determining what you can qualify to borrow when you're buying a home. The challenge is being an entrepreneur presents some pretty unique challenges when it comes to the income piece. Proving income, there's no pay stub like an employee would get, so we have to dig deeper. You might have fluctuating earnings, meaning, 1 month or 1 year to another, your income's changing. There's perceived risk. Because of the two pieces above, lenders think you're a bigger risk than someone who has a paycheck. And fitting into the box. You don't fit into their pre-built boxes. They don't understand you or your business. They're just constructing a straightforward way to determine your income, and they're not digging deeper. So lenders are going to prioritize predictable income that will be used to cover ongoing expenses, your existing debt, and the new home that you're looking to buy. For income, they will take a 2-year average of your personal income tax declared income. For entrepreneurs, lenders are going to turn to the last 2 years of your personal tax returns, and they're going to look at some of the examples here, like business income, professional income, commission income, if you're a sole proprietor or self-employed. Now, if you are incorporated, you might have T4 dividend income if you're paying yourself a salary or taking a dividend from your company. Again, we're looking at the 2-year average here. So what you've reported over the last 2 years and then taking an average of that. Practical solutions and strategies. The best part is that an entrepreneur, you have more options than the average borrower. It's important that you stay organized. You got to keep your financial records organized, bank statements, tax filings, profit and loss statements ready to go. Plan ahead. Start the process early so you can better control your outcome. Lenders are looking for 2 years of history, so you need to be prepared 2 years before you're thinking about buying if you're going to be showing 2 years of tax returns. Be strategic. Structure your income to balance your income tax savings and your borrowing power to make sure you're prioritizing the right one. You're trying to get savings up for a down payment by keeping your income low, or building your business by keeping your write-offs high and your income low, but you also need to keep that income high to be able to qualify for the mortgage that you're going to need. It's important to understand your options. There's an array of solutions for entrepreneurs. If personal income isn't enough, we've got lenders that will dig deeper. So here's a real life budget, and let's break it down on how it would look to buy a home as an entrepreneur in Toronto. We've got the traditional mortgage option here on the left and an entrepreneur mortgage on the right. There's three pieces of information for me that really stand out here: the annual mortgage rate, the lender and broker fee, and the monthly mortgage payment. These are going to be the key differences between a traditional mortgage and an entrepreneur mortgage. Interest rates on an entrepreneur mortgage are going to be slightly higher. And then you've got the lender and broker fee. Typically, you're looking at 2% of the amount that you're borrowing. And that is going to play a factor in how much you're going to need to close. And then the interest rate is going to impact your monthly mortgage payment and the total expenses on the home. So in this situation, we're looking at someone who's a first-time buyer purchasing a home for 1.4 million with 20% down. In that case, you're looking to borrow 1.12 on the mortgage. You got closing costs on this property, 280,000 in down payment, lawyer fees, appraisal, land transfer tax, additional closing costs from the lawyer, and on the entrepreneur's mortgage, you've got that 2% lender broker fee. Case one, traditional mortgage, you're going to need about 324,000 to close. Case two, you're going to need about 346,000. Your monthly payment, call it 7,900 on the traditional mortgage and 8,100 on the entrepreneur's mortgage. Not a huge difference. Where the entrepreneur's mortgage really makes a difference is looking at the income required to qualify. An entrepreneur's mortgage is going to look at the bank statements. They're going to look at what kind of income is flowing through your business bank account in terms of revenue that your business is generating, and then determining what kind of profit your business has and allow you to use that as your income to qualify for the mortgage. A traditional mortgage is going to require you to report that income on your personal tax return, which means a big CRA bill. So in this example, let's look at what it would take to qualify. With a traditional mortgage, interest rates being what they are today, you need about 1/5 of the mortgage amount as income. So for personal income, that would be about 224,000. And let's say on the other side, as an entrepreneur's mortgage, you're just reporting the income you need to live your daily life, pulling out the expenses you need to cover on your personal life. That's what you're going to take as an income. Let's say that was $90,000. Business cash flow, not applicable here on the traditional mortgage, but on the entrepreneur's mortgage, we need about 200,000 positive business profit, revenue less expenses from the business bank statements to qualify for the same mortgage. When we look at the income tax impact of this, the income tax rate on 224,000 is 39.3% in Canada. This is for Ontario. 29.3% on 90,000. That's an annual income tax of $88,000 to report that $224,000 a year income. Over 2 years, that'd be $176,000 in income tax to show the income you need to qualify for that mortgage. If we look at the entrepreneur's route, now we only have $26,000 a year in tax on our 90,000 in income. Over 2 years, that's 52,000. That's a savings of $123,000 in taxable income. Now, if we carry that over to the scenario we had before, where we needed the extra $20,000 to close the entrepreneur's mortgage, the total closing costs plus your income tax for the 2 years would be about 500,000 with a traditional mortgage, where you'll only need about 400,000 with the entrepreneur's mortgage. That's $100,000 savings that could be put into a down payment, allowing you to do this much sooner than you thought possible. This is where the entrepreneur's mortgage really makes a difference. I hope this helps you understand the difference between a traditional mortgage and an entrepreneur's mortgage. I think the thing to remember is that entrepreneurs can secure great mortgages with the right strategy. If you got any questions, feel free to reach out. Below this is a link to fill out a quick survey to see if you're in a position to qualify for an entrepreneur's mortgage today. If you've ever felt like banks just don't understand how entrepreneurs make money, you're not alone. Maybe you've been told you don't qualify or that you need to pay yourself more in order to. The mortgage system wasn't built for people like us, but that doesn't mean you can't get the financing you deserve. Hey there, I'm Marshall, and welcome to my training on mortgages for entrepreneurs, where I'll break down exactly how self-employed professionals, business owners, and freelancers can qualify for a mortgage without the usual stress and frustration. By the end of this session, you'll have a clear roadmap to understand exactly what lenders are looking for when you're self-employed. Learn key strategies to increase your mortgage approval odds without overpaying on taxes, and find out which mortgage path fits your situation so you can take action today. Again, I'm Marshall. I'm a mortgage broker here in Toronto with 12 years of experience, and I've helped over 450 borrowers secure more than $250 million in financing. Plus, I've been an entrepreneur myself for 20 years, so I know exactly what it's like to juggle business, whether you're ready now or need a game plan to get there. Let's go.